Are you in the process of shopping for a new home, or perhaps you're already under contract, but you're not sure what steps to avoid in order for you to have a successful closing? Hi, my name is Tatyana Clark with Buy Sell Central Florida, brokered by Coldwell Banker, and today I'm going to discuss with you 5 things for you to avoid before closing. If you have embarked on house hunting journey, congratulations. If you have already gotten the pre-approval letter, even better. And if you have already gotten under the contract, congratulations. This is fantastic news. However, this journey is not over yet until you close on that deal. And I'm going to help you to ensure you get to that finish line. So stick around. The first thing you want to try to avoid during this period is switching your jobs. Let's say you were employed for a company and you were getting W-2, and all of a sudden you decide to quit the job and maybe start your own business. Well, guess what? Right now might not be a time for you to do that until you close on the home. So the mortgage brokers and the lenders, they are looking at the stability of your employment. Ideally, they're looking at least a couple of years of steady income in the same industry. So if you do get an exciting offer for maybe similar type of role in the same industry for more money, that might be great. However, do not make any decisions without speaking to your lender first. You want to make sure that you doing the switch during the closing period does not jeopardize your chances of obtaining financing. Item number 2 for you to avoid is switching banks. The reason being is that lenders, once again, looking at the stability. They want stability in employment. They want stability in your banking, in financial institutions. Any changes during that period might scream red flags to them. And what happens is, while you are getting through the process of approval for the loan, your lenders will typically request bank statements for at least a couple of months. Sometimes they go as far back as 6 months or even longer. So it would not be an ideal situation for you to switch the banks unless you have a very solid explanation to do though. So unless there is an extreme important reason why you have to do that, I would definitely recommend for you not to do it. Item number 3 for you to avoid is depositing large amount of money into your bank account. And by large amount of money, that might mean different thing for different people. For some of you, the lender might request the explanation for $1,000. For some of us, it could be $5,000. So what our lenders are looking for when they screen through the bank statements, they're going to look for unusual activity. Perhaps it is the income that has not been reported on your taxes, or some large amount of money that was deposited that has no explanation. So any big amounts coming out or coming in is going to be red flag, and likely the lender will request the explanation for that. So it's definitely not a good idea to deposit the money. And some of you might think that if I deposit a large amount of money, it might look good on my statement because it will just show that I have money, right? Wrong. This is not the time to play with your bank statements. You want to show stability. You don't want to have one-off transactions that might scream like red flag to your lender. So definitely do avoid that. And let's say if your loved one or your family member wants to contribute towards your closing, maybe it's a gift from your parents or your brother or sister or whatnot, and you want them to contribute towards your down payment or closing, that is great. And there are ways of doing it properly. So do talk to your mortgage broker, and instead of taking cash from them and depositing it into your bank account, there are ways to show it perhaps as a gift letter. And your lender will be a perfect person for you to help you strategize what's the best way of doing it. Because many times they might just ask those people to wire funds directly to the title company and just sign the gift letter. So there are definitely ways to do it without jeopardizing your ability to obtain financing. Item number 4 for you to avoid is to get into more debt or obtaining new loans. The reason being is when your mortgage lender issued you that pre-approval letter, they've already looked at your credit history. They already looked at all of your debt obligations. They already calculated debt to income ratio, and they already issued you the pre-approval letter for your house based on those guidelines. So if all of a sudden you go and get into more debt, that can jeopardize your ability to afford the home that you are now under contract for. Another thing that people I see do a lot is that they either get a new car right before the purchase of the home, which really works against you most of the time. Or even better, people get excited that they got under contract, that they finally get in the house of their dreams, and they start shopping for new furniture. Guess what? This is fantastic. Look for furniture, but don't buy it quite yet on your credit cards. Sometimes people might think, oh, they got such a good deal going on. They have 0% financing for the next 5 years. I can definitely afford it. Great, you might be able to afford it, but all of those monthly payments and obligations are gonna count against your limit or debt to income ratio. So definitely do not get new loans, new cars, new furniture until you close on the house. Because unfortunately, I've heard of some horror stories when, because people bought a new sofa or a car or whatnot, they were not able to obtain the financing. I do not want you to be in the same boat. And finally, item number 5 to avoid is being late on your payments. The reason being for that is when the lender gets you the pre-approval, they're running your credit report, they're pulling up your credit score, they're looking at your ability to pay your bills, and hopefully all of that is on time. So if during that process you neglect to make payments, especially if any payments are delinquent for more than 30 days, it might get placed on your credit report. And what that does, it jeopardizes your credit score. So it could be placed as a derogatory remark on your credit report, and it might even lower your credit score. And there is a big difference between the two different score types and what kind of interest rates you are able to afford. Just to give you an example, if your credit score is 720 and let's say it drops just by 5 points, right? And it's now 715, all of a sudden it places you in a different scale, and your interest rate could be very much different from the one that you would previously qualify for, and that means higher mortgage payment amounts. And therefore, do everything possible to keep current on all of your payments so you do not jeopardize your ability not only to obtain the financing, but obtain the most favorable terms for your financing. And we just covered 5 items for you to avoid before closing, because I want to make sure you guys have a smooth sailing all the way to the finish line. And that's why it's so important for you to have an experienced professional on your side who can guide you through the process step by step. And of course, this list is not all inclusive because there are so many other nuances, which is exactly why you want to have professional on your side to guide you through the process, so that some mistakes as such could not be so costly that you lose the deal. Once again, my name is Tatyana Clark with Buy Sell Central Florida, brokered by Coldwell Banker. And I really appreciate you tuning in. Thank you for watching. You have a great day.